Hi everyone, welcome to Charts and Perspective, where we use charts to dive into the world of economics and financial markets. I'm Jennifer Nash, an economic and market research analyst for TMX VettaFi. Is the stock market sitting on a ticking time bomb? According to Warren Buffett's favorite market metric, we're currently living through the second most expensive stock market in human history. Today we're going to take a look at the Buffett Indicator, also known as the market capitalization to GDP ratio. Back in 2001, legendary investor Warren Buffett called this probably the best single measure of where valuations stand at any given moment. But right now, this indicator is flashing a massive warning sign. At its core, the Buffett Indicator is simple. It takes the total value of all publicly traded stocks in a country and divides it by that country's gross domestic product. Think of it as comparing the price of the stock market to the actual economic output supporting it. Following the latest Q1 GDP estimates, the traditional Buffett indicator skyrocketed to 229.7%. To put that in perspective, this is the second highest reading in history, only beaten by the quarter right before it. According to the raw data, the stock market is deeply overvalued. But looking at the raw data doesn't tell the whole story. If you look at this chart going back to the mid-20th century, you'll notice a massive upward trend. Our economy and market structures have changed over 70 years, so to get a fairer picture of today's market, we need to detrend the data. By drawing a statistical regression line through the history, we can see how far we are drifting from the historical norm. When we strip away that upward baseline and apply standard deviation, the picture gets stark. The current 229.7% reading sits a whopping 64.9% above its historical trend line. Statistically, that's 2 standard deviations out of bounds. We're in strongly overvalued territory, historically speaking. To put this in perspective, there are only 2 other times in history we've seen levels this extreme. During the irrational exuberance at the turn of the century, and again during the peak of 2021 just a few years ago. Now, the traditional Federal Reserve data used for that calculation uses a metric called non-financial corporate business liabilities, which can sound like a bunch of confusing accounting jargon. To keep the math simple and transparent, we can look at an alternative version that uses the FT Wilshire 5000 index as the numerator. Think of the Wilshire 5000 as a broad index that tracks practically every public company in America, making it a much more intuitive way to measure the market. A quick note on accuracy. Some analysts cheat the math by pairing today's stock prices with lagging GDP figures, which can distort the reality. For our charts, we're strictly matching concurrent time periods. Even with this cleaner Wilshire metric, the indicator sits at 214.4%. Again, the second highest level in history. So how well do the 2 versions match up? When you overlay the Fed data version with the Wilshire 5000 version, they're singing in almost perfect harmony. The Fed data has slightly more upside volatility, but both metrics paint the exact same picture of the modern market. So what's the ultimate takeaway? While the Buffett Indicator is an incredible tool for assessing long-term macroeconomic health, it's absolutely not a short-term market timing tool. As you can see when we overlay it with the S&P 500, markets can stay overvalued and keep roaring upwards for years before a correction happens. It's a gauge of risk, not a crystal ball for next week's portfolio moves. To wrap everything up, whether you look at the traditional Fed data or the Wilshire 5000, the Buffett Indicator is telling us that stock market valuations are sitting at their second highest level in history. We are mathematically way out of bounds compared to the historical trend line. But remember, this isn't a signal to panic or try to perfectly time a market crash tomorrow. Instead, use it as a high-level reality check to understand that market risk is incredibly high right now. That's all for our discussion. Thank you for tuning in. For more economic and market insights, you can find my content on the Advisor Perspectives website under the AP Chart section.